Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. And we have the Fed watched, a pause that refreshes. Does it? Guess we're going to find out, right? For the first time since the Fed began cutting rates back at the September FOMC meeting, the voting members decided to keep rates unchanged to begin 2025. So as a result, the Fed funds trading range remains at 4.25, 4.5. Now, remember, this level for overnight money is still 100 basis points below where Fed funds was trading prior to the beginning of last autumn's rate cutting process. So sitting back, taking stock of the economic and inflation landscape does make some sense. And the question is whether this is the pause that refreshes and leads to future rate cuts later this year or not. And one important aspect that comes to mind is the visible difference in the narrative that accompanied the January Fed gathering as compared to back in September. You know, back then, the widespread belief in the money and bond markets was that economic inflation conditions would result in an aggressive rate cutting response from the Fed. And while the aforementioned 100 basis point decline in Fed funds in just a 3-month time frame may have fit that bill, the current macro outlook is one where the Fed does not need to act with any further urgency, at least at this time. So, as I'm speaking to you here post-Fed, Fed funds futures are still pointing to a year-end target somewhere around 3.9%. And that's not only right around the Fed's own dot plot, but it's also more than 100 basis points higher than where expectations were 4 short months ago. And speaking of 100 basis point increases, that's also what has happened to the Treasury 10-year yield during this same period. So I say, what's the more pertinent question? Well, it's where do Powell and company go from here? And the Fed chairman has reiterated that policy has been recalibrated with the goal of becoming less restrictive and moving Fed funds into a more neutral territory. And that's data permitting, of course. And that's where the uncertainty comes in. And, you ask yourself the question, well, what is a neutral Fed funds rate? And in our opinion, the level is now higher than what prior Fed estimates had been showing. And it could be in the 3.5 to 4% area. And the policymakers seem to think the neutral rate has risen as well. But what the Fed decides is the appropriate level may be a moving target in the months ahead. So, when I look at Fed funds over the last, say, let's call it 30 years or so, right? If the voting members follow through on bringing Fed funds or the target down to a neutral reading, let's just call it 3.875. Okay, that's 3 7/8 to make it simple. It's a level between 3.5 and 4, and similar to the Fed's median estimate for 2025. And they stop easing there, that would mean there could potentially be only a couple of rate cuts for this year. And one other policy aspect to be on the lookout for from the Fed is their plan for quantitative tightening, QT. The policymakers have already tapered the pace of balance sheet reduction, so it appears it's now a question of when, not if, to end QT in the months ahead. But, the bottom line is the updated outlook for both macro and rate cuts this year leads us to believe that Treasury yields will remain at normal, elevated readings. Remember, those are more normal readings, what we're seeing now. We've talked about this before. And in fact, if you want to add on to that, in my opinion, the path of least resistance for intermediate and longer dated maturities, that is treasuries, could actually be skewed more to the upside. So more on that later. I'm going to sign off on that. I hope everybody is well, and take care and have a great rest of the week.